So yesterday we had a fantastic session, introductory session of Dr. Professor Pal with regard to accounting for groups, where Sir discussed the different nuances of Ind AS 103. He has put forward in front of us some of the nuances, some of the points to understand and think with regard to business combination. And today, as Sir said, he will continue and proceed towards Ind AS 110. So I'm not wasting any valuable time by doing a formal introduction, because I'm not that sort of a formal person. Formal definitely, but I don't believe in that those formalities are always needed, because Sir knows how much we respect him and we know how much we can get from Sir. So without wasting much time, I invite Sir to the platform. Sir, the virtual stage is yours now.
Thank you. Thank you very much. And now I am going to present my PPT. Is it visible? Am I audible and is it visible?
Yes, sir.
Yes, sir,
It is
perfect.
clearly visible. It is in full screen mode, and you are clearly audible, sir.
Okay. Okay. Then I am going to the next part. Next part of my lecture, that is on consolidated financial statements. And this part is a bit more difficult than the previous one. And so I have to rely on your more concentration and also the way I would be trying to make you understand certain difficult areas, because in most of the available literature, the particular difficult areas or some complicated areas are a bit avoided. And so whenever I would bring them into discussion, it would create some problem. I can avoid, but I'm not going to avoid those things before you. As uh, generally, you may have in other um, available textbooks and even the um study materials and other literature. Now, from the first point, I am going in the same way, word by word, I would be explaining. I would be not skipping anything, and some additional explanation or discussion can be made, but I won't miss any point here. Consolidated financial statements are required to be prepared by an Ind AS compliant company if it holds shares in the investee company in the following order. Not always, in the following cases: entailing 20% or more voting rights, having significant influence over the investee company, and in such case the investee company is called associate as per Ind AS 28. So if you have 20% or more voting rights, and uh, with that you have significant influence over the investee company, then it would be your associate, and in that case you have to prepare consolidated financial statements as per Ind AS 28. It is not under 110, but separate Ind AS. But still, as per 129 clause 3 of the Companies Act, it is consolidated financial statement. Now you see, for the word, this term, consolidated financial statement, you have to go to the Companies Act 2013, section 129, clause 3, because in Ind AS 28, the term consolidated financial statement is not mentioned. It is stated financial statements, they have to put that. So in that way, if you are in a confusion that what to write, then you would be in a trouble unless you can compare it and see the different parts. entailing 20% or more voting rights having significant influence over the investee company called associate. Then entailing joint control over the investee company. If you have not full control, but jointly with any other company, you have control over the investee company called a joint venture as per Ind AS 28. Again, it is called joint venture as per Ind AS 28. And in such case, whether consolidated financial statement should be required, yes, it would be required. That has not been clearly stated initially when in the Companies Act initially. At that point, associate was mentioned, but joint venture was not in that way clearly mentioned. But on subsequent amendment, they have included it clearly to avoid the confusion. So now we can say that entailing joint control over investee company called a joint venture as per Ind AS 28. So what percentage can be? It can be near say 35%, 30%, 40% share with that, another having 30%, 40% share, both having uh, total 80% share and control over the joint control over that without consent of one, the other cannot individually take any decision. In that case, it is joint control. And entailing control over investee company, that means you have control, no joint control, no significant influence. More than that, you have control over investee company. If you have that kind of shareholding, so it may be say with 45% share, you may have control over the investee. If it happens that other 55 such a way heterogeneous they have not united force, and with 45% you have effective control, you can establish. Then with 45% share, you will have control. So entailing control over investee company. So whenever it is more than 51% or more than that, you have control. You need not again explain that. But if it is below that, at least if any certain theoretical questions are there, in that case you would be answering that in that way, and you would see the how the different criteria are mentioned, that whether you have power and control over the investee company, even with less than 50% share. And in that case, the investee company is called subsidiary as per Ind AS 103 also, and as Ind AS 110. Ind AS 110 is the main section, main standard here, Ind AS 110, where subsidiary is defined, and 103 is also to be applied, but subsidiaries, it is mentioned, defined in Ind AS 110 clearly. And no consideration is required, no consolidation is required otherwise. That is, if these cases are not there, consolidation would not be required. For holding shares in investee not falling under above three clauses, in that case, consolidation would not be required. The investor company prepares only individual financial statements, what we called earlier standalone financial statements. Now, there are two names in place of standalone financial statements used in different uh, uh, current literature. One is individual financial statement and another is separate financial statement. Separate financial statement is used for the standalone financial statement when consolidated financial statements are prepared. And when no consolidated financial statements are prepared, then this standalone financial statement is called individual financial statements. I think these parties, uh, the initial explanation is given for these three parts. Okay, then I would come again onto that for journal entry, etc., etc. Then I am coming to Ind AS 27 and Ind AS 28 again. Ind AS 27 requires that when consolidated financial statements are prepared, the investor company shall also prepare separate financial statements, which is same as individual financial statements, but it is called separate financial statements. In the separate financial statements of the investor company, investment account is recognized for holding shares in the investee company in the separate financial statements. That is, as if their own financial statements, individual financial statements. The investor company of the investor company, investment account is for holding shares in the investee company. So what account is recognized? Investment account is recognized. Whether it is an associate, joint venture, subsidiary, whatever it may be, investment account is only recognized. It is measured at cost or as per Ind AS 109. That is for the individual financial statement. As usual, investment account would be recognized in their own balance sheet. In consolidated financial statements, consolidated financial statements are required to be prepared as per Ind AS 28 under equity method. Then, when for associate and joint venture, consolidated financial statements are required, then they are as per Ind AS 28, and in those cases, the consolidation should be made under equity method. Under equity method, what is that? When investor company has significant influence or joint control over the investee, associate or joint venture. In that case, equity method would be applied. Under equity method of consolidation, no assets or liabilities of the investee is recognized. No, their assets and liabilities are not taken into consideration, not combined. Rather, only that investment account is recognized at different value, not at cost or as per Ind AS 109, not in that way. The investment account is measured, recognized and measured at cost plus share of investor in post-acquisition profits, both profit or loss and other comprehensive income in the investee. So the investment account would be continuously modified, changed, rather revalued at what cost plus at cost that was whatever their original, then plus share of investor in post-acquisition profits, both profit or loss and other comprehensive income. Suppose I had 20% shares and its cost as it was originally recorded at rupees amount I am putting, say for rupees 40,000. 40,000 is the value at that initially it was recorded in the balance sheet. And after 1 year, the associate had made a total profit, say total both profit and loss and other comprehensive income taken together, total profit of 50,000 annual total aggregate. That is total comprehensive income. Profit and loss and other comprehensive income taken together is total comprehensive income. The total comprehensive income is 50,000. So my share is 20%. So 20% of 50,000 would be 10,000. That 10,000 would be added to my investment. So my investment is already 40,000. Now it would be added by rupees 10,000 and it would become 50,000. After 1 year, it would be recognized at rupees 50,000. So my accounts have to, entries should be passed in my accounts where investment should be debit and profit and loss, my profit and loss and my other comprehensive income both would be credited by the share. Suppose their total comprehensive income 50,000 of the associate, total comprehensive income 50,000 of that associate was divided in 30,000 profit and loss and 20,000 other comprehensive income. So my share would be 20% of 30,000, that is 6,000 as profit and loss to be credited, and 20% of rupees 20,000, that is other comprehensive income. 4,000 should be other comprehensive income credited. So in my account, investment account would be debit 10,000 and profit and loss credit 6,000 and other comprehensive income 4,000. That is share from associate. Share from associate. In that way, it would be done. I will be showing that also in the next slide. I must have shown some journal entries. I cannot just remember at this point whether it is there or not, but I expect it will be there. And then I am coming to Ind AS part 110, that is the other part. That is when it is a subsidiary. When invested company has control over the investee company subsidiary, consolidated financial statements are required to be prepared as per Ind AS 110 by recognizing, not by equity method here, by recognizing assets, liabilities, non-controlling interest, goodwill, or gains from bargain purchase. At the acquisition date, at acquisition as per Ind AS 103, that is at acquisition point, it would be as per Ind AS 103. And
It's बहुत
thereafter,
गंदी चीज है। बलबीर सिंह सिद्धू कह रहा है कि मैं अगर कांग्रेस आ जाती है पावर पे तो आई बी मेकिंग अ न्यू मेडिकल कॉलेज इन द स्टेट। भाई वैसे नहीं बनाएगा। एंड ही इज द हेल्थ मिनिस्टर एंड ही इज द हेल्थ मिनिस्टर। हाँ
Excuse me, Gurpreet ma'am, please. Sir, we have muted her video.
hello.
Sir, we have muted the video, sir. You can proceed. Sorry, sir.
Okay. Okay. And so you see, at the acquisition date, as per Ind AS 103, we have to recognize the assets, liabilities, non-controlling interest, goodwill or gains from bargain purchase, etc. And share of post-acquisition profits in the subsidiary company would be added thereafter. Share of post-acquisition profits in the subsidiary company would be afterward it would be taken. Now I am mentioning again that particular sentence. I have some made explanation not fully clear to you. By recognizing assets, liabilities, non-controlling interest, up to this part it is okay. And then goodwill or gains from bargain purchase at acquisition as per Ind AS 103. Only this item, this goodwill or gains from bargain purchase, it is only at acquisition as per Ind AS 103. Other items would be at acquisition whatever you get, and thereafter, after post-acquisition, whatever change in assets, liabilities, change in non-controlling interest, everything would be recorded, everything would be taken. But only goodwill and gains from business purchase would be at acquisition. What was, what you found, what you measured, that you have to put in your consolidated balance sheet. No subsequent changes should be incorporated on goodwill or gains from bargain purchase. That has been meant here. And so, and share of post-acquisition profits in the subsidiary company, that would be that the in consolidated balance sheet up to pre-acquisition profit, it is already included in net assets and liabilities, already included. And only post-acquisition profit should be taken care of in the consolidation process. So before that, so far before Ind AS 110, as per old system, the book values were recorded, book values, and so uh, pre-acquisition profits, book value are taken, and in that way, that system is not followed now. Now, at the time of acquisition, you have to recognize all net assets at present value. And when you take present value, all the revaluation profit and all the pre-acquisition profits are included therein. And in that way, you find your goodwill, and also you recognize in your accounts the assets at present value. And so the pre-acquisition profit part would no more appear in the accounting process. Only post-acquisition profit should come. No investment account is recognized for holding shares in the subsidiary. In consolidated balance sheet, investment account is not recognized. In individual balance sheet or in separate balance sheet, separate financial statement, investment account is only recognized. But in consolidated balance sheet, investment account is replaced by all these assets, liabilities, and other items. A parent is an entity that controls one or more entities. These are the definition part only. A subsidiary is an entity that is controlled by another entity. A group consists of a parent and its subsidiary. Thus, it appears that a parent has to report consolidated financial statements based on 100 Ind AS 103 and Ind AS 110, because both are required, because goodwill and gains from bargain purchase, you have to put based on Ind AS 103 as required in Ind AS 110. Then I am showing the journal entries of all these three cases. When a company purchases less than 20%, when a company purchases less than 20% shares of another, four cases. Less than 20% shares of another company, the transaction is recorded in the books of investor as investment debit to bank, to equity, whatever. Investment account will appear in individual balance sheet of investor company. Simple, no other thing. When company purchases 20% or more and having significant influence, it has to be understood, or you have to assume that or mention that 20%, implying that it has significant influence in the investee. Then investment account debit to bank and equity, same. Investment account would appear in a separate and also in consolidated balance sheet, because consolidated balance sheet would be required, and so separate balance sheet would also be required. In the subsequent years, in separate balance sheet, investment account will be carried at cost or as per Ind AS 109. But in consolidated balance sheet, it would be measured, valued at under equity method. So, however, in consolidated accounts, investment accounts shall be valued under equity method. If in subsequent years, investee company's net assets change, assume increase by profit or loss and by other comprehensive income, following journal entries shall be passed in the consolidated accounts of the investor company. Investment debit to profit and loss, share of profit and loss, to other comprehensive income, share of other comprehensive income. Thus, in consolidated balance sheet, investment account shall appear at cost plus share of investor company in change of net assets of the investee, and other equity will increase by share of profit and loss and OCI of the investee. So this investment account will rise in the books of the investor, and also other equity will rise by these two figures, by profit and loss, share of profit and loss, and by share of OCI. So in consolidated balance sheet, what is named consolidated balance sheet, all the investors' own accounts would be placed, only investment account would increase by increase or change by net assets, change in net assets, and other equity would be affected for profit or loss or share of other income, other comprehensive income. This is the required accounting for investment in associates as per Ind AS 28 and 27. The same accounting is done for investment in joint venture, so we are not showing that separately, where the investor has joint control. Next, we come to when by purchase of shares investment, by purchase of shares, investment company acquires control. Investor company, not investment company. Investor. But when by purchase of shares invest, again that. Acquires control of investee, not joint control. The investee becomes subsidiary and investor is parent. For such transaction, at the acquisition date, accounting shall be made in consolidated accounts of the parent and also in the separate accounts of parent. We have done it also yesterday, a bit repetition, so I am quickly going through this. In the separate accounts, investment account to bank, in subsequent years, separate balance sheet investment account will be carried at cost or as per Ind AS 109. Now, for consolidation, however, in consolidated accounts, following entry will be passed, and that we know: assets, goodwill, consideration, liabilities, prepared interest, etc. This journal would be passed. Now, consolidated balance sheet at the acquisition date, if you prepare, thus at acquisition, at the time of acquisition, if you prepare consolidated balance sheet, then what would happen? The assets and liabilities of parent at carrying amount are combined with the fair value of assets and liabilities of subsidiary for preparation of consolidated balance sheet. Mind that here the carrying amount means book values of the parent and the fair values of the subsidiary are added to find the consolidated balance sheet figures. Earlier, in the old days, or when this Ind AS is not applied, in those cases, we generally, what we did, we added the book values. Both book values are added, but here we are not allowed to do that. We have to take the fair value of subsidiary and the book value of the parent for the consolidated balance. Goodwill is shown under non-current assets or gain on bargain purchase is shown under consolidated, is shown under consolidated other equity. Other equity, we may write consolidated other equity in consolidation balance sheet. That under other equity, that gain on bargain purchase would arise, goodwill would arise under non-current assets. Non-controlling interest is also shown below other equity. Below other equity, non-controlling interest is shown in the balance sheet. Thus, we see that preparation of consolidated balance sheet under Ind AS 110 at the acquisition date is simply incorporating the entries of business combination with the balance sheet items of parent. And that's as simple as that. Subsequent consolidation, there lies huge difficulties. Subsequent consolidation, and certain points I have to bring them before you, whether it is very much difficult, complicated. Still, I would try to. Subsequent consolidation. For subsequent consolidation, the post-acquisition changes in assets and liabilities and in non-controlling interest should also be considered, but no change should be made to goodwill gain on bargain purchase. Those items, goodwill or gain on bargain purchase, would remain as it is at the time of acquisition, at the time of business combination. What you measured, that is final. But other things would change: assets, liabilities, non-controlling interest, and also the other equity part. Other equity. Four items should be there. Not should also be considered. Subsequent consolidation, post-acquisition changes in assets, liabilities, and in NCI, and in other equity. I should add that. Should also be considered, but no change should be made to goodwill gain on bargain purchase. In subsequent consolidated balance sheet, non-controlling interest is measured at value at acquisition as per Ind AS 103, what you measured, that value, plus share of non-controlling interest. That is, suppose they have 20% share, so that 20% in post-acquisition profits. Because at the time of acquisition, their non-controlling interest was measured under Ind AS 103, and after that, post-acquisition, whatever profits or losses would be there, whatever profits here means uh, other comprehensive income included, total comprehensive income actually. In post-acquisition, total comprehensive income. So share of NCI in post-acquisition profits implies post-acquisition total comprehensive. Note that NCI as per Ind AS 103 can be measured at fair value or at proportionate value at net asset identified. So whatever it would be, two values can be taken, whatever it would be, you have to take that value and then you add whatever post-acquisition changes are there. In subsequent consolidated balance sheet, goodwill gain on bargain purchase is recorded at acquisition date value as per Ind AS 103. That is consideration plus NCI minus fair value, etc. Whatever formula you have used already. Now, one point I have discussed here on dividend, because I won't have time to discuss thoroughly the dividend treatment in accounting part details. Only this one point I am mentioning, as dividends from pre-acquisition profits were already included in the acquisition date fair value of net assets. You think what you, at the time of finding goodwill, what you have done, you have taken fair value of net assets in your consideration, and whatever dividend subsequently declared from pre-acquisition profits, those were included in your fair value of net assets. So that has been already there in fair value. As you have considered fair value for measurement of goodwill, so this post-acquisition dividends from post-acquisition profits, afterwards, whether dividends are declared from pre-acquisition profits or from any other profits, whatever dividends declared, those adjustments that we usually do from finding adjust the goodwill value, that goodwill value is adjusted for dividend treatment, that would not be necessary in this treatment. Here, as we take the fair value on the date, whether dividend is included in an amount which is afterwards declared as dividend, or it is not including that amount, whatever it may be, fair value would remain intact. So it is no more required to be deducted separately from purchase consideration again for any adjustment to goodwill. So that you would keep that in mind, that as fair value of net assets at the time of acquisition is taken into consideration for goodwill, and for any dividend declaration whenever made, the fair value of the net assets are not affected. They would remain same. And so, based on fair value of net assets, whatever goodwill you have measured, that won't change. That would remain same. So for that reason, the rule is that whatever you found at the time of acquisition, goodwill value, suppose goodwill, whatever goodwill value you found, that is final. That won't change afterwards. That is in consolidated set of accounts, not for individual set, where investment account is recorded. Not that case. Here the rule is ordinary. Whatever you have done, that will be continued. But in consolidated set, the thing has changed. That was one issue that I told, a bit complicated. And then here this slide is another very complicated one area. And that has been skipped by many books, many materials, etc. I would bring that to your notice, whether you may take it for consideration. It is okay. If you find that it is too much complicated, or at this point it can be avoided, then you may skip also. But I am going for the complicated part also. That at the time of acquisition of shares in subsidiary company S, subsidiary, identified assets and liabilities of S are recorded in the consolidated accounts at fair value. Subsequently, non-current assets and liabilities of S are carried in the consolidated balance sheet at acquisition date fair value plus subsequent change in book value. That is, they would not be afterwards taken at fair value. That is, suppose on 1st April 2020, the fair value of non-current assets and liabilities, net non-current assets, suppose fair value of net non-current assets was 5 lakhs, and on 31st March 2021, that is after 1 year, the book value is 4,50,000. Earlier, on the earlier date, that is 1 year before, the book value was 4 lakhs. Fair value 5 lakhs, book value 4 lakhs. Now that book value has raised to 4,50,000. So there is increase in book value by 50,000 during the year. Now, initially at the acquisition date, we would consider not book value 4 lakhs, but fair value 5 lakhs. And after 1 year, what value we should take? The book value is then 4,50,000. Should we take 4,50,000? No. What should we take? Fair value 5 lakhs plus this change in book value 50,000. So 5,50,000 should be taken. So that is stated here, that acquisition date fair value plus subsequent change in book value. The current book value is irrelevant. That is not required for consolidation. As current fair value is irrelevant. That is not considered for consolidation. If the current fair value is given, that at 1 year back the fair value was 5 lakhs, current fair value is 5,70,000. That 5,70,000 we won't take. We will only consider current, subsequent, whatever book value, and in what way that book value is different from the initial book value. So we can take current book value, okay, whatever current book value 4,50,000, and then add the initial revaluation profit 1 lakh. Initial revaluation profit was 4 lakh book value and 5 lakh fair value. So initial revaluation profit 1 lakh. That we add. In both ways we can find it. We can take simply current book value 4,50,000 and then add the initial revaluation profit 1 lakh, 5,50,000. So in that way we have to find the subsequent value of assets and liabilities, non-current particularly, assets and liabilities of the subsidiary. But in case of current items means current liabilities and current assets, the rule is not so. The rule is simply we have to add their book value. That means at their book value means as usual, as before. That is parent company's book value plus subsidiary's book value, current book value. We would add them. Why? Why that? Because in case of current assets and liabilities also, at the time of acquisition, we recognized what? Their present value we recognized. And suppose that present value, suppose the net current asset is 3 lakhs at the time of acquisition. Net current asset is 3 lakhs, book value 3 lakhs. And their present fair value is 3,60,000. So book value 3 lakhs and fair value 3,60,000. So there is revaluation profit of 60,000 in case of current assets. And after 1 year, when we are preparing subsequent consolidated balance sheet, the current asset value, book value is 4 lakhs. Book value is simply 4 lakhs. So what we should take for consolidation in the subsequent year? Should we take 4 lakhs as current net current assets? Or we would take 4 lakhs plus that 60,000 revaluation profit we would add as for non-current assets, as done for non-current assets. No, that would not be done. We would take only 4 lakhs. Why? We have already taken 60,000 revaluation profit. Why? At the time of acquisition, we increase the current assets not at 3 lakhs but at 3 lakh 6. We have taken that at 3 lakh 60,000. Then here you read what is written there. For current items, the revaluation profit or loss on the acquisition date, difference between fair value and book value, is reverted through post-acquisition retained earnings. That is, whatever would be revaluation profit, that would be reverted, that would be cancelled in post-acquisition time. That is, in post-acquisition year, after acquisition in 1 year, we would cancel that 60,000. And so If we cancel that, post-acquisition profit would be reduced. One way, that is one result, post-acquisition profit of the subsidiary would be reduced by that amount. And the other item is that the current asset valuation based on the fair value, 3,60,000 plus increase during the year 1 lakh increase, 4,60,000, that would be again coming back to 4 lakhs. 60,000 would be reduced. In that way, this reversal would be made. Why? Thus, the book values of parent and subsidiaries are simply combined for consolidation. So far as asset is concerned, book values of parent and subsidiaries, so far current assets and liabilities are concerned, book values of parent and subsidiaries are combined for consideration. That part would be simple. Non-current, there is certain complication, but current, when you are combining assets or current liabilities and current assets, simply book values you can add to get that. But this is the ultimate result of first considering fair value at the acquisition date and then reverting that in the post-acquisition retained earnings. Why that? I am giving one example to explain that. Suppose unsold stocks of subsidiary on acquisition date had carrying amount of 1,000, that is rupees 1,000 or that, and fair value 1,200. After 1 year, on the reporting date, it is assumed being fully sold at 1,300. Stock would not remain in the same position like fixed assets. It was sold and it was sold even at a higher price, not at 1,200. It was sold at 1,300. So post-acquisition profit amounted to 300, includes for this 300 post-acquisition profit. Now, these 300 should be reduced by 200 for consolidation, as this 200 has already been considered as revaluation profit at the time of acquisition. Now, this 300 profit, which is a really post-acquisition profit, that includes 200, which was earlier in consolidated account has taken as revaluation profit. So you cannot take this 300 and again that 200 revaluation profit. So that 200 revaluation profit you have to maintain for 103 because fair value. And this post-acquisition 300 you have to reduce by whatever revaluation profit you have made earlier. So this is one simplest example. Other complication you need not develop. Only based on that you keep this idea and maintain this. That whenever for current assets, always you would assume that would be transacted in post-acquisition period, and whatever revaluation profit or loss would be there, that would be ultimately reflected in post-acquisition profit and loss, and automatically post-acquisition profit and loss, you have to reduce that or increase that. If it is a already loss, revaluation loss, then you have to increase. If it is revaluation profit, you have to subtract that. So this thing, whether you understand or not fully, keep this as a rule, at least, that this should be done for current assets, current items. Then I am not going, I am coming one simple example of consolidation and also applying Ind AS 103 as we have done in the last class. One example would be simple example of consolidation. You see, company P Limited acquires 80% shares of company S Limited. Parent acquires 80% shares of subsidiary. On a date by issue of equity shares 1st April 17. Issue of equity shares of rupees 10 each at a premium of rupees 30. The financial data, that means we would assume the fair value of each share is 40. The financial data of the companies on 31st/3/17 are stated below. Non-controlling interest is valued at fair value. Non-controlling interest is valued at fair value. It has been instructed because non-controlling interest can be valued at fair value or at proportionate value. And the balance sheet. The balance sheet is shown in this fashion because it is summarized or abridged form. It is for parent, it is for subsidiary, and it is fair value. Subsidiaries fair values are required on the balance sheet date just before acquisition. At the just before acquisition, 31st/3/17, and 1 year after acquisition, this is the parent company's book value and subsidiary company's book values are given. Now, fixed PPE, plant, property, and equipment, that is what we understand as fixed assets mainly. That fixed assets are only one item there, parent 720, subsidiary 480, and fair value of S is subsidiary 700. So 220 is higher, 220 revaluation profit. Keep that in mind from this. And parent and subsidiaries 480 was the book value. Now the book value is 560. So it is also 80 up during the year. So at the time of consolidation, you take not 560, the book value. You take 560 plus 220 because revaluation profit you add. In that way, 560 plus 220, that is 780 and 800. So 1580 would be total PPE. Just mental calculation we can do that because we know 220 is the revaluation profit. So with this you add simply revaluation profit. So it gave is 780 and 780 plus 800, 1580. Or in the other way, what you can count, that 480 to 560, 80 rupees increase. So 700 plus 80, then it also becomes 780. And 780 plus 800 book value of P. So consolidated PPE would be 800 plus 780, 1580. Investment in S, just 1 day before, that was on 1st April invested on 1st April 17. So investment in this figure, there is no investment. On 31st/3, just 1 year after, the same amount is stated here. 640 is the investment in S. That is, P Limited, in the earlier I told you 80% share purchased at rupees whatever, I'm finding the previous. 80% shares, equity issue of 40. And for 80%, the amount total is 640 lakhs, rupees in lakhs, 640 lakhs. Then current assets, again you see, regarding P, it is not very much important. Regarding S, 350 and now 300. So there is loss. There is a loss. And fair value is a loss. And then currently 360. So if I ask you what would be the consolidated current assets, then you simply add them. book value 350 and here book value 500 and this 360. So 860 would be the consolidated current assets. You need not bother about at present at 31st C if you prepare it would be 860. Why? Because this loss, revaluation loss was there at the time of acquisition, but that loss is reverted, that is again added in the profit, post-acquisition profit. So that 50 loss once taken as pre-acquisition and then again reverted in post-acquisition, just cancelled, and so it has no impact on the asset valuation. But pre-acquisition and post-acquisition profits are, you have to keep in mind that there is a pre-acquisition revaluation loss of 50 and post-acquisition reverted, that is addition. Reverted means profit. Whenever it is loss, it will be taken as profit of 50. That you have to take into account because post-acquisition profits should be considered for consolidation. And equity means equity share capital and other equity taken together. That figures are given. Non-current liability, again you see that there is increase. If there is increase in non-current liability, then again it is revaluation loss. So there is one loss of 50, there is another loss of 10. So 50 plus 10, 60 is the total loss. No, it is non-current. No, it is non-current. Sorry, current. Current, there is another loss of 30. So 50 plus 30. So there would be total 80 loss in current items. 80 loss and 80 loss would be reverted afterwards. Then with this given figure, it is stated that past entries for business combination, as we know, we started with that under acquisition method, then show consolidated and separate balance sheet abstract, because not in full form we would show on 31st 17, that is at the time of acquisition. Okay, it would be on 1st April because acquired on 1st April. So I would just change it. Now, initially you have to some working notes. That purchase consideration is 640, that you can remember, 640. If paid up capital is 10 and premium 30, then 1/4 is equity share capital and 3/4 is security premium. In that way, you divide them. Then fair value of net identifiable assets fair value of S. You see, PP fair values are given already. PP 700, current asset 300, non-current liability 310, current liability 200. In that way, net assets 490. So, fair value of net identifiable assets, was 490. Then NCI at fair value, that is non-controlling interest at fair value. Is it fair value mentioned in the problem? Let me see. Is valued at fair value. Okay. So non-controlling interest fair value. So when you know that for 80% you paid 640, then for 20%, what amount you should pay? 20 by 80 into 640. In that way, you find the fair value of non-controlling assets as it has been not stated separately. So you use this process that purchase consideration is at fair value for 80%. So non-controlling interest for 20% should be based on that 160. Once you find that, goodwill would be consideration, that is 640 plus NCI 160 minus net asset 490. It comes to 310. And once that goodwill is calculated in the first year, when at the time of acquisition, when you're preparing consolidated balance sheet, goodwill is 310. In the next year, it would be 310. In the second next year, it would be 310. It won't change. Other figures should all change, but goodwill will not change. Then this journal entries, I am not taking time because it has been explained yesterday that this whatever assets debit and all these items are credit, and goodwill balancing figure and purchase consideration debit, equity share capital, security premium. Security premium would arise under other equity. Then consolidated balance sheet. Consolidated balance sheet of P and its subsidiary S on 1st April. You see consolidated balance sheet. 720 was the figure of the parent company. Parent company, on that date, the value was PP 720. So in separate balance sheet, 720 would only be mentioned. And the fair value was of the subsidiary 700. We have told that 480 was the book value and 700 was the fair value. So you take the fair value, 700. 720 plus 700. In consolidated, it would arise 1420. So two columns are shown in abridged abstract form, so that separate and consolidated can be shown just by two columns. Separate is parents only own, and consolidated is two taken together. Goodwill you have calculated 310 on the date of acquisition, that you put. Investment in consolidated, there is no investment, but in separate the investment amount 640 is placed. Current asset is 450 for the parent company, that appears in separate, and 300 is the fair value of the subsidiary. That total 750 is in the consolidated, and their total is 2480 total assets. In separate, total assets is 1810. Then equity, it has two components, equity share capital and other equity. But here, short in brief, I am showing only the total amount. 500 was the equity of the parent, and 640 plus it issued further 640. So 500 plus 640, total 1140 was the amount of equity of consolidated, and same is for separate, because whether it is separate or consolidated, it is only parent's equity that you have taken. And parent's equity was originally 500 and then they issued 640. Thus the total has become 1140 in both the cases. Non-controlling interest, there was nothing in separate, but 160 you have computed and that you put in the consolidated under equity. Non-current liability, then the fair value of the book value of the parent 350, you put it under separate. Fair value 310 added, you put it under consolidated. Current liability, 320 is the book value of parent, put it here. 200 is the fair value of subsidiary, add and put it in the consolidated figure. Thus, the total is 2480 and 1810, total equity and liability. At the acquisition date, preparing consolidated and separate is easy. It is more comfortable. You feel comfort about that. There is nothing difficulty here. Then for the next year, before going to the consolidated, you have to now some working notes you have to develop. What? Particularly other equity of subsidiary balance. Other equity balance was 360. It was the balance. I can go back to the problem. It is called equity. Let me see. 360. Now, other equity is not 360. Balance is equity is 360. And balance 1 year before is 300. So increase, and that increase is your increase in other equity. That's 60. So total equity has increased from 300 to 360, and we can assume that there is no such increase in equity share capital. All increase is there for other equity part. So other equity increases during the year by 60. And we know revaluation loss of current asset was 50 and current liabilities was revaluation profit. Is it revaluation profit? I have missed it. Let me see. Previous. Yes, current liability reduction means you have profit. Current liability reduction means you have profit. Current asset reduction means you have loss. Current liability reduction means fair value is less. That means you have to pay less. That means it is profit. Sorry. So revaluation profit on current liability is 30. So ultimately, revaluation loss of net loss of 20. Mind that it is for current, so it should be reverted, and reverted would be this loss would be shown as profit. Revaluation net loss reverted means it would be profit. It is taken as profit increase. So 60 was increased, and then revaluation that you have to account for another increase of 20. So 60 plus 20 post-acquisition change in other equity is 80. What was post-acquisition profit? Here we would call, I am writing here post-acquisition change in other equity. You may write post-acquisition profit also. So 80. So of this post-acquisition, parent share is 80%, 64. Non-controlling interest is 20%, 60. That you need to find. Pre-acquisition part is not required. Post-acquisition part is required. 64 and 16. Then consolidated equity, that is consolidated equity is parent's own equity plus whatever post-acquisition from subsidiary. So consolidated equity is 1240, it is parent's own equity plus 64 from subsidiary, this amount 1304. NCI is the same way. They had 160. NCI was 160. Non-controlling interest was 160. We have already done that. And the post-acquisition part is increased 160 plus 60, 176. Then the balance sheet. Here, PPE, you see, separate parents own 800, and that is under separate. Then subsidiaries is 560, book value 560, book value 560, plus revaluation 220. We told earlier 1580, that is 807, 1580 is there. Goodwill, same, 310, no change. Investment only in separate 640. Current asset, their book values total in the consolidated, and 500 is here separate. Book values total simple. That part is simply book values total. Then total asset you put 2750, 1940. Equity, here also we are not dividing it, putting total equity. 1304 we have found for consolidated, and for separate 1240, that is parents own part only. Non-controlling interest 176, you computed that because it is 160 plus 60, 160 plus 16, 176. Non-current liability again, this 320 parents own, that is under separate, and 320 is the book value plus 10 revaluation profit non-current, 650 is taken here. Current liability only book values total in consolidated, and the parents own is here. The total equity and liability agrees. In that way, you finish the balance sheet where you have taken, except dividend issues, most other issues are taken into consideration. Separate, consolidated, at the time of acquisition, after 1 year, pre-acquisition, post-acquisition, all these things are taken into consideration. Now there are other problems also, but I think we should leave some time if you have any question, because at a stretch I am continuing this and it is quite difficult and almost impossible to follow every point and keep that in mind and accordingly fully understand that. But it would at least introduce you to the idea, and some parts of it you could keep in your mind, so that when you would be going through this, or you would be teaching to your students, mostly what would happen, you can pick up simple problems and discuss them to them, not everything, all the complicated parts should be included there. So I have certain other problem and solutions in mind that I should show, that in certain syllabus, current syllabus, there is mentioned that finding pre-acquisition profit, post-acquisition profit, etc. And that is not, we cannot say that we those are all wrong things. Pre-acquisition profits are there, really there. And if our index 110 prepares things in other way, that doesn't mean that pre-acquisition profit is vanishing from the picture. So if pre-acquisition profits are like that, profit and loss figures, etc. are given, from that side also we can prepare it. From that side also we can prepare it. So that has been shown also, that from that side how we can prepare. But before that, is there something written on that? Have I written something on that? No, I skipped that part because that would create further confusion. So I skipped that part. Okay, okay. So whatever the other things remaining not discussed at this point, I would be going back to you to uh, say that whether you have any question or any uh, particular issues to discuss, then you may point that out whether what is the time now? 100, 18, 11, 18. Another 10 to 10 minutes at least is there. So, people,
Exactly, sir. Exactly, sir.
so,
We
so,
have roughly 10 more minutes. Yeah.
hmm, so I am just
So,
at
dear
this point.
participants, as Professor Pal is asking that if you have any query, so you can place it before sir. And we can understand that sir has given us enough food for thought. So, sir, if you share your presentation slide with us, because many of the participants yesterday, they were asking for the valuable
Yes,
insights that you have provided.
I'll do that. I'll do that. But I have some taken from some publications, my own publications, but uh, uh,
Hmm.
some I would some change, make some change in figure. I think
Okay,
that
sir.
would be better,
Okay, sir.
because the same thing I
Yes,
have
sir.
just taken here without thinking much, and I had not
Hmm.
time. So whenever in some materials, study materials, or in some other published materials I have sent, either I would mention that references that where it is you can get these details, that I can do.
Okay.
But also
Sir,
I would give
please,
this,
that will
I
be
would
even
also
better. That will be even
give
better.
this particular mm, um, PPT with certain changes of figures, with certain modifications. So I would take another one day to make some changes and um, revise it, and then there are one or two mistakes also in the PPT, so I would change it and then I would send it to you. Suppose
Okay,
tomorrow
sir.
I would send it to you.
Sure,
Okay.
sir. Do
Hmm.
as you feel comfortable, and then I will forward it to the participants.
Yes, that I would do.
And sir, with your due permission, I will share your email ID with the participants as well, so that if they have any future query, then we will they can approach you through email.
Yes, yes. Is there feedback from there? Asking for feedback from
Yes,
uh
sir. Yes, sir. At the end of every session, there are feedback
oh,
forms as required by AICTE Training and Learning Academy.
yes, 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 yes.
So, sir, there are feedback forms. Sir, actually,
Okay.
many of the participants feel, as in other one-day webinars or 1 or 2 hour webinars, that it is on the basis of feedback forms that certificates are given. But in
Okay,
ATAL
okay.
FDP, it is not that. ATAL
Hmm.
FDP, they have strict regulations that attendance should be 80% of out of the total time duration, and the final examination of MCQ-based test is conducted. There, the candidate should score 60% plus. Then only they are
Okay.
eligible to this valuable certificate of
Okay.
completion of this.
Okay. It's very, very stringent, and
Exactly,
our
sir.
time that kind of difficulties were not there.
Exactly. And
We
sir, this
just enjoyed
certificate is
the
given due weightage. This
uh,
certificate is given due weightage, sir, for
yes,
promotion
yes,
and for appointment as well, because these
yes,
are
yes.
very challenging at the same time.
That is very positive, very positive.
Exactly. And sir,
That
we
is
must appreciate the fact that the government of India through AICT is providing this free of cost for the participants. They are doing
okay.
100% sponsoring of this.
Okay. Yes,
So I
yes,
believe as participants, we should give something, at least our intellectual effort
yes, 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 yes. That seriousness is at least required,
required.
and
Exactly.
all the time, all the time.
Exactly.
Yes.
And sir, the participants are very serious. There are many senior participants as well, sir, which you will love to know.
Yes, I find that all the some I know some university senior teachers are there
Sir, if I
participating.
may interfere, Dr. Rashmi Soni, she is raising her hand. Can I take her question, sir?
Yes, 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 yes,
Yeah.
yes.
Hello. Good morning, sir. It was
Good
very
morning.
interesting to understand the Indies, because as you rightly said that it
Ma'am,
is
if
very
you can
difficult to.
introduce yourself to sir first, because
Okay,
he
fine.
doesn't know
Yeah.
you.
So I am Dr. Rashmi Soni, and I am from KG Somaya Institute of Management, Mumbai. I
Yes,
teach finance and accounting courses to MBA students.
yes, yes,
So professionally, I am a fellow member of Cost Accountants. So
yes.
yes, Indies and conversion and IFRS is not a subject which you know